This is Chris Matthews from TradeForexFundamentally.com. Today's video is how to profit with Forex options in any market environment. What can you do with Forex options? You can trade a directional view while limiting risk. You can bet that the market will move even when you're not sure of which direction it may move in. You can bet that the market will just move sideways in a range, or you can profit if you know where price won't go. A lot of people are good at guessing where the market will go, but a lot of people are also good at guessing where it won't go. And people who are good at selecting support and resistance levels may excel at this part. So we're going to explore a couple different options here. In the regular so-called spot forex market, you can't do these type of things. You're limited to just either buying a currency or selling a currency. So if you're good at guessing where price won't go, as I mentioned before, or whether it will move or not, regardless of the direction, options are for you. If you find that you're often right about direction, but your timing is off and you get stopped out too often, options are also for you. So let's consider four different scenarios. One, you may know which way the market is going to go, but you don't want to get stopped out. Two, you may know which way the market won't go. Three, you don't know which way the market will go, but you just believe it will move. And four, you believe price will just range calmly in a sideways fashion. So let's consider the first case. Let's say that you're long this currency pair. It's currently at 0.87 or so, and you want to give it some time because you're not sure if it's going to move right away, or it might move right away, but the price action may be kind of choppy. So you do what's called buying a call. And there's a lot of different color curves here. Just ignore that. Look at the blue curve here, which is this hockey stick type of thing. It's flat, and then it starts to increase at a certain price level called the strike price. So what happens is you buy an option at that price, and then the as the currency pair moves in your direction, the option becomes more valuable and you make more money. If it moves against your direction, instead of losing a lot of value, the option just loses its premium value, and then after that is flat. So the amount that you can lose is capped, unlike in regular forex trading. So in this case, you buy yourself a lot of time, whereas normally you would get stopped out. So by buying yourself time, you allow price to move up and down until it finally moves up enough to reach your profit target somewhere up here, wherever that may be. Now let's consider the second scenario. You may know which way the market won't go. So let's look at this plot again. By the way, this is called a profit and loss plot in options terminology. On this axis, it shows you how much money you're gaining or losing depending on where the currency or so-called spot price is. So if we're looking, for example, here, perhaps this is the Aussie dollar / Japanese yen pair, and right now it's about 90.5 or something, wherever this line is. And you're thinking that perhaps this pair won't go down below this value much. It probably won't go into the 90s or the 87s or 85 ranges here, because if price goes down, then your option position is going to lose a lot of value here. So again, ignore all these colors, just look at the hockey stick type thing. It's a straight line here and then it goes flat. So in that case, you can do what's called selling a put. So as long as price doesn't go in the downward direction, in this case the left direction indicates that price is going down. As long as price doesn't go down, then you make money right away actually. So if it stays where it is, as you can see after the option expires, if it stays where it is, you earn $100 right away. If it moves up a little bit, you earn more money, up to about $700 here, but your gains are capped. Okay? So that's if you're good at guessing where price won't go. Suppose your analysis tells you that there's a support level around 90 or something, and price probably won't breach that. Now let's consider the third scenario here. You don't know which way the market will go, you just believe it will move. If you don't know if price is going to go down or it's going to go up, but things are brewing up in the market and it's going to move strongly in one direction or another. So what you can do here is called buying a straddle in options terminology, and that this red line represents where price is right now, where the currency exchange rate is right now. So say this is Aussie yen. I'm actually not sure what this graph was constructed from, but it's at about 91 or something. So you can buy both a call option and what's called a put option at the same time at this price, and it forms this V sort of formation, meaning that you're initially at a loss as soon as you buy it because you have to pay a premium, pay what's called a premium when you buy options. And as long as price moves sufficiently downward or to the left on this graph or to the right, which means price is either decreasing or increasing in value by a lot, then you're going to make a lot of money. So in this case, you don't have to be right about direction. You just have to be right that volatility is going to increase. Okay, so you pay about $1,000 here initially, but you can make up to that much on either side in this range. If it goes down to 80 or up to 100, that's kind of a big range, but that's because this was done on a large time scale. But you may choose to trade on shorter time scales like weekly or daily or something, or some people trade on monthly or yearly time frames, but it's totally up to you. So the last scenario we have here is scenario 4. You believe price will just range calmly. And there's a number of different positions you can construct, but this one is relatively simple. It's called a butterfly because of the way it looks. There's the head of the butterfly and then two wings coming out each side. And let's pretend, for example, price is right here at around 90.5 or 91, whatever this is. And you believe that price has been just, if we looked at a Forex price chart right now, we would just see this sort of sideways range of price just chopping up and down, and you believe that it will continue chopping up and down between around 88 and 91. So you construct what's called this butterfly, and it's done by buying calls at a lower price, selling a couple calls at the price where the currency is right now, and then buying a few more calls at this price up higher here. And if this doesn't make sense to you, don't worry. This will be explained in other posts or the ebook if you're interested in actually learning how to trade this. But the point is, it's really easy to construct this position, and you're really profitable as long as price remains confined to this range. However, if price goes beyond this range, let's say all the way up to 95 or all the way down to 85, you lose money, but your losses are capped. Plus, if price goes all the way down to 85 and hits that level, you don't get stopped out. You still have until the expiry of the options term for price to come all the way back. So if it touches there, comes all the way back, you don't get stopped out. You get a profit and you make money. Okay, so based on all these positions, as you can see, options offer the flexibility that regular trading just doesn't give. This allows you to more effectively trade the rhythm of the market and earn smoother, consistent returns if done correctly. And as I've mentioned before, Paul Stafford and I have created a newsletter that will recommend options trades for you to take based on these type of strategies. So stay tuned.